How many of you, just two or three of you did some re-entry on that test, Clayton, you and Cole, as long as you were here? Good place tonight, don't you? Okay, can you stay late? Can you stay late? Something different about you today, your hair today. To let her hair down. The Terry's quit smoking today, so you see her again, hold her to it. Good friend. How many years have you smoked, Terry?
Since I was 15. I'll be 38 in December, so.
2 years. I know I started, I was 12, 13. So far, it's okay, but I smoked cigarettes in college. I smoked 2 packs a day. Started smoking cigars, and hell, those make you run. You don't want to run away from them. I started pipe. Pipe's not as bad. I don't inhale it directly. When they're smoking around you, you know you want to inhale it. Probably cigarettes would kill me by now if it's just cigarettes. So if it's all nasty, it's all bad. How much have you been smoking a day, Terry?
About a pack and a half for about the last, I don't know, 10 years or so.
Okay, now how much does a pack cost?
About $5.80.
$6?
Yeah.
Let's just add on $2 more for that pack. 3, that's $8.
Yeah.
7 8 is 56.
Yeah.
Somebody multiply $56 by 300, no, by 52. What? 365. Multiply, I'll say $7, $8, $8. Multiply $8 times 365.
What is that?
No. 2,900? Wow. 3,000 a year. Boy, I'd buy you 2 big screen TVs. I'd buy you a second car.
I'd be happy just to have the first one paid off. That's why I'm doing this. Tired of paying $400 a month on a car payment.
Take you on a cruise.
Yeah.
There's a lot of money in it. You know, when I talk to some economics, because I broke it down, even though I spoke myself, not only is it the cost of cigarettes, but when you're out of cigarettes, you'll walk a mile. It used to be an advertisement. I'll walk a mile for a camel. You run down the road 5 miles to get your pack of cigarettes. That's cash money. You'll buy lighters. If you buy them through those zip-in markets, they cost over $1.50. They don't last long. So that's more expense. Probably have more doctor appointments. Either sinuses or whatever, which I've got.
Bronchitis. Bronchitis.
Mm-hmm.
I keep bronchitis.
Not only that, you stink up a car, if you smoke in your car, that decreases its value. You dirty up a car. There's so many drawbacks to any kind of tobacco. Pipes, cigarettes, cigars, sugar tobacco, stoves, snuff, whatever you want to call it. Too many drawbacks. Okay, so for 3 of you, excuse me, we'll end class about 1:30. Give you some time to take your tips. Now, we know, you know, and I know, I can't give you credit for true false. If you miss a true false, damn blaming, you know the other answer is correct. But I'll give you credit for all the multiple choice you get right. You got 3 choices now instead of 5, but I can't give you credit for true false. So I don't know how many true false are on there, about 15 maybe? 15. Huh? Yeah. Well, I made it to give you credit for the multiple choice you get correct, and then we'll look at some other method there. We're on chapter 8, I guess. Either I didn't go over that test enough, some of those items. So let's look at page 2 of your textbook. I'm not going to fool with PowerPoint right now. Some of these things we mentioned last week, some we didn't. But on page 8-2 is transaction that may result in a loss. Sale or exchange of property. We know that can be a capital asset. Exploration, seizure, confiscation, condemnation. Now, if your property is condemned, you can take a loss on it. All right. Seizure, I guess you can get your car taken in a drug raid or whatever. Now, probably, if you're on the Hatfield and McCoy's trail on a 4-wheeler and you haven't paid your fees, can they take your 4-wheeler?
They just
Fine you? But now, if you're hunting illegal and you're on a 4-wheeler, they can take your guns and 4-wheeler. Okay, so seizure, abandonment of property, worthlessness of stock, planned demolition of property in order to construct new property, destruction of the property by fire, storm, which is any other case, and then of course theft, and deductible business expenses when it exceeds income, you've got a net operating loss. Okay, let's look at some of these again. We are ahead of schedule this semester. We'll cover chapter 8, and chapter 8 has installment sales. Chapter 9 is a good chapter. It goes along somewhat with itemized deductions and employee business expenses. Now, if we get those 2 chapters covered, I'm happy. But if we can get to a chapter 10 on depreciation, I'd be happy if we could get that chapter. All right, so we won't go any further than 10, that's for sure, and we'll be lucky to probably get 10. I'd like to have 2 more tests to give you a change. We haven't covered enough to have a test, but we'll see about 2 more tests or 1 more. I know October's about gone. You'll get off a week in November, and then the semester's gone. It's going by quick. This is probably, today's October what? What? You'll have the 30th. You'll have November, let's say the 6th. November the 6th, 13th, 20th, and I guess somewhere around the 27th will be Thanksgiving week. We'll miss 2 days. And then we'll get back. It will be December, somewhere around the 4th. I'm not trying to be exact. And I'm sure you have to have exams and grades turned in somewhere before the 15th. So after this week, and this one gone, we're talking approximately maybe 6 more weeks at the most. Probably 5 more like it. So time will fly by. All right, in this chapter, we're talking about losses. Now let's try to sell or exchange a property. We know that's Schedule D. We know that's usually a short-term capital gain or loss. In this chapter, it would be a loss. We know that would be a long-term capital loss. All right, in this chapter, it would be a loss. Now, we know you can take up to $3,000 a year on long-term capital losses. And short-term, you can take it all. Okay, so sell or exchange of property, and the amount of the loss is taxpayer incurs in a sale or exchange equals the excess of the property's adjusted basis over the amount seized realized for the property. And we know the difference between realize and recognize. And what little bit they give you here, on seizures, confiscation, or condemn. The most common one is condemn. They can condemn your property for a school, a hospital, a road, what have you. Abandoned property, I gave you the example last week. If a coal mine abandons that mine, it may be worthwhile just to leave the equipment in there and not pull it out. Whatever the book value of that equipment is an abandoned loss, and you could take it. And then worthless securities. I gave you my own personal illustration where my son talked me into buying penny stock, and it went worthless. Also, when I was at the community college, a lot of people donated $12 stock, and the company's name was Enpro. It was an electronics company, something located down in Tazewell, Virginia. Well, the college had around $100,000 or more in donations where people giving it to them. Well, people had bought it for 50 cents a share. Then on their taxes, they were able to take off $12 a share for a donation. So it reduced their taxes. All right. But I was doing the college foundation return. And I knew that Enpro, that $12 stock, went down to is worth about a penny a share. It was going out of business. So I learned this, and I talked the president into letting me mark that off of the balance sheet of the colleges. They had to mark it off the balance sheet as a loss. They didn't have that anymore. And it was false information to leave it on there. Anyway, that foundation return got so big that people donated buildings to the college and money, endowments that totally financed the music department and the professor. And it got big. And finally, I talked him into getting an outsider because I was doing this thing. It was taking up my whole Christmas break to get that foundation return. I got no extra money for it. So, and to do a foundation return, there's lots of attachments and schedules. So, worthless. Stock can become worthless. If you have stock in a company that's operating in Iran may own the property now and you own nothing. So investments in foreign countries. Okay, and then turn down a building on page 4. Turn down a building. You know, if you pay $50,000 for landed building, let's say the building's worth 10, land is 40. All right, but you got $50,000 there. Now you may, you've had this in principal accounting. You may tear that building down. If you do, you've got $50,000 in land. You may pay somebody $1,000 to tear that building down. So now you've got $51,000 in land. That's all you've got. The building's gone. You had to pay somebody to tear it down. It made your land better. Okay. All right. You want to subdivide that land, and you pay $10,000 for roads, power lines, well, electricity and water and sewer. You're going to have to add that on the land too, and add it onto the basis of each lot when you subdivide property. Okay. Or you can depreciate a road if it's gravelled, but I would just add it all on the land. So that is demolition of property. Now, classifying the loss on the taxpayer's return, ordinary versus capital. Now, if you can take an ordinary loss, you deduct 100%. Or if you could take a capital loss, you can deduct 100% if it is short term. Now, I told you long term, you can only deduct $3,000 per year. Now, that's pretty much a few details on ordinary versus capital loss. Look at the example 4, and you should read all these examples. Page 5. On July 24, the current year, all right, this LLP company sells some investment property for $75,000. The property's adjusted basis is $85,000. Well, you have a $10,000 loss. The investment property is a capital asset, and you realize $10,000 loss. If instead the property had been destroyed by fire and the partnership had received $75,000 insurance proceeds, the $10,000 would have been an ordinary loss because it's a casualty or a theft. So, same property can be a capital loss or ordinary loss, depending on how you look at it. Now, section 1231, property. Now, we should have a better section on this, but for what it's worth, at the time being, I'm going to give you just the basic. We've looked at this before. All right. It's all about recapture of depreciation. Okay. It's all about recapture depreciation. Now, if you buy a $20,000 vehicle in your business and you depreciate it, this is its cost. Depreciation is $18,000, and your book value is $2,000. All right, now sell this. You're not going to sell it above its cost. We know that, unless it's some kind of fancy antique. Okay, now if you sell this if you sell it for $1,000, you got a loss, a legit loss. If you sell it for $3,000, you got an ordinary gain. If you sell it for 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18,000, up to 18,000, you've got an ordinary gain. All right, of 16,000. All right, even if you sell it for 20,000. Your book value is $2,000. You got an 18,000 ordinary gain. But once you sell it above this amount, if I sold that old truck, collector's item, for 23,000, I've got a 21,000 gain. 18,000 of that gain, recapture or depreciation, is ordinary. And then 3,000 would be, wait a minute, book value is 18. Yeah, if I sell it for 23,000, I'd have a 3,000 long-term capital gain. You've got to sell it above the original cost or original basis before you have a long-term capital gain. Anything up to that is recapture or depreciation. IRS is not going to let you take depreciation on something and save 35% taxes, then let you take that depreciation as a long-term capital gain and pay 15% taxes. They're not going to do that. That's why it's recapture. Now, that's just a little bit about Section 1231. Now, look at Section 1244 stock. All right, individuals may deduct losses as ordinary up to 50,000 per tax year, 100,000 on a joint. The stock must be owned by an individual. The stock must have been originally issued by that corporation. The stock must be stock in a domestic company. The stock must have received the stock in exchange for cash or property. All right, as long as you got small business stock, Section 1244 is small business. You can take the whole 50,000 and you're not limited to $3,000. All right, what does the word passive mean in taxes? We've had it before. All right, look at page 7. First off, let's get off track for just 1 minute. Jonathan, what do you think about that caravan coming to our country? You heard about it? No? Clayton has. What am I talking about, Clayton?
That big truck, or you talking about that thing that went across the border? Right.
What went across the border?
I don't know, some truck or you said caravan. I seen
Caravan,
something about a big parade. They like pushing through people. I've seen something.
Terry, you know one of them?
The people from Honduras trying to cross the border.
They come from Honduras, El Salvador, some of those Central American countries. Started out as 2,000, went up to 4, went up to 7. Now, just pictures of that caravan. Well, some of the news people call it a moving mob. 7,000 people, they make over 14,000 people. They pushed through the Mexican border, and the police just backed up. And now some people are giving them bus rides, truck rides, whatever, companies and so forth. Whoever some of them are funded by, they're giving water and food along the way. Bathrooms, I guess it's just out in the field somewhere. 7,000 people on the move. They'll reach our border. Probably take 2 or 3 weeks. So what it's all about, do we take in 7,000 people that are not applying to get into our country right away? Now, all of you all have ancestors in Europe that migrated here probably. Or from some other country, okay? This whole country was made up of immigrants at one time. They came from Spain, and they came from Italy and Germany and England, and Scotland and Ireland, China. Our whole country was made up of immigrants. But now if we take in 7,000 immigrants, they gotta be fed, housed, school. It'll cost our country a lot of money. Now, where do you work, John? You work, Terry? And Johnson works. Oh, we're gonna have to write him out a definition of work. But, yeah, just kidding, Cole. Anyhow, you all pay taxes. Now, you may be getting everything back right now, don't know. But when you pay taxes in, we gotta pay taxes support up there. So, you heard about it, Billy? But for 7,000, I don't know how close they are to our border. We can't kill them. It's almost like an invasion. They want to come here illegal to get jobs. And most of them are young men, able-bodied men. There's some kids and there's some women. Older people that have made that march. They've been marching for a couple, 3 weeks. So this country must be good. They want in it real bad. But they're still carrying the Honduras flag, Terry. Some of them still carrying the Honduras flag. Honduras is that bad, why they carrying their flag? But really, they just want to come here to get jobs and a better life. There's a lot of violence down in Honduras. So people want into this country, and we're blessed to have this country as it is. So it's your own personal opinion whether we should let them in or not. All right. But anyway, since you all don't watch the news, that's one of the latest things in the news, okay? All right, a passive loss. Usually it applies to real estate. Now, before 1987, taxpayers were able to reduce their income tax on their salary or on income before business investments with deductions, losses, and credits arising in other activities. This year, taxpayers often invest in activities called tax shelters that would spin off tax deductions and credits. Many of these tax shelters were simply passive investments because they did not require the taxpayer's involvement or participation. Now, if you've got money invested in real estate, this is usually the biggest passive activity. And you do not materially participate. There's passive activity. So you're on a trailer court. You collect rent every month. That's probably a passive activity. So what are the losses limit to is the problem on these passive activities. Of course, if you're getting interest on a bank account, that's a passive activity. You're doing nothing. You're not materially participating. All right. Look at page 8. Look at passive income and losses. You compute income and loss in the passive category for each passive activity in which they have incurred. In general, for any tax year, a taxpayer may use losses in one passive activity to offset losses in another. All right, but may not use them to offset other active, let's say W-2 income. So look at example 5. During the year, Kisa CPA reports 100,000 of active business income. Well, that's straightforward. That's what we've been studying. He also owns 2 passive activities. From activity A, he earns 10,000 of income, and from activity B, he incurs a $15,000 loss. He may use 10,000 income to offset the loss. So his loss is $5,000. All right. He may not deduct the 5,000 excess loss. So we're going to find when in the current year. All right, so he'd have to carry it over. So look at example 6. Tammy reports the following income and loss: 200,000 salary. She's got a 40,000 loss, passive activity X and Y, and she's got income Z. 40 and 10 make 50, minus 30 makes 20. All right, that's all this figuring is doing. Thus, Tammy has a net passive loss of 20, which must be carried over to subsequent years. The amount of carryover attributed to each activity is as follows. All right. Your loss was 50,000. Your income, let's see. Activity X, 40 over 50. Activity Y, 10 over 50, times the 20,000 carryover. So you've got 16 to carry over and 4 to carry over. Carry it over the next year. We will have to study more and look at problems on these passive. So please look at all your examples on passive losses and carryovers. Now I want you to look at page 10. We've had this before. A definition of a passive activity includes any trade or business in which the taxpayer does not actively materially participate, as well as any rental activity. So all real estate. All right. Cole, you and Jonathan have a partnership. Maybe you got some kind of retail sale. All right, you split the income 50-50. Well, they both materially participate if they work 40 hours a week apiece. You materially, that's not passive. Okay, we'll take the same business. Jonathan and Co. owns a retail business, partner. But Jonathan just needed Cole's money. And Cole wanted to stay home and play video. All right. So Jonathan is out there working, busting his butt, and making a lot of money. Well, at the end of the year, he has to give Cole some of that money. So even though it's a retail business, Cole did not materially participate. Jonathan has ordinary income. Cole has passive income because he did not materially participate. So that's the distinction, materially participate or not, and then also real estate. Now, it doesn't matter if it's income. Jonathan pays taxes, so does Co. But it matters if it's a loss. Jonathan's going to take all the loss. Co may have to put that loss off to next year or part of it. That's the difference, and we'll practice problems. All right. So please read those 2 pages, 10 and 11, on what is a passive activity, what is materially participating. Read the next 2 pages. So read those 4 pages pretty good, okay? Now, rental activities. If you're in a rental business, if you went out here and bought, pay $200,000 for apartments. At one time, you would take more depreciation than you were getting income on those apartments. That was a tax loophole. IRS tried to close that loophole by changing our depreciation system, which you'll see in chapter 10, MACRS. Instead of just plain old straight line, declining balance, sum of your digit, and units of production. You'll see what all businesses have to use for depreciation. All right, we don't teach it in principles or intermediate. We only teach true depreciation and taxes for tax purposes. Okay, so read about real estate, please. All right, let's move over to casualty and theft losses. That tells you what a casualty is. A deductible casualty loss is one that occurs an event sudden, unexpected, and unusual. So, if your water pipes rust, is that sudden? If your water pipes rust, is that sudden? Not, is it? All right. So now those rusted water pipes may cause a casualty if they flood your house, but just the water pipes themselves, no. Okay, we know what a casualty is. And since Clayton's the only one that knows anything about the news, and maybe Terry, Clayton, what were some casualties that's happened in this country in the last month? Hurricane. All right. There's been two big hurricanes. I don't know if they were both in the last month, but the latest one that hit Florida and Georgia. The one before that hit North and South Carolina pretty bad, and some of Virginia. All right. Hurricanes. And I'm sure we've had earthquakes somewhere. That's a casualty. Fires can be started by nature. That's a casualty, even if they're started by someone. Our last big fire out in California destroyed one of the national parks. I forget how some man said he set that fire. I don't know if he had a campfire or if he had threw out a cigarette or what. But people usually set fires. Hopefully they're unintentional. When I was out in Arizona this summer, it was so dry at a campground, you could not even burn charcoal outside. No wood fires, no charcoal fires, and no smoking. You could not smoke outside. You'd be fined. So I was down, I guess, at the little general store that each campground usually has. And they were telling me those laws. I said, how about a pipe? Anyway, the lady there said, I think a pipe would probably be okay to smoke outside. So I did smoke it. But if the wind were blowing, I would probably help my hand over it, make sure a spark, because a spark can start a fire. And Arizona's had some big fires. Okay. Okay, so we know what causes a casualty. All right. You paid $10,000. You depreciated $2,000. Its basis is $8,000. Its fair market value is $12,000. Okay, whatever that was, maybe that was a business pickup. Now, how much can I take as a casualty here? It cost 10, appreciated 2, book value is 8, fair market value 12. So I have a casualty now. How much can I take? Do I take the book value or the fair market value? What do I take? The lesser of the two. And would usually be the adjusted basis. Book value and adjusted basis, we're talking about the same thing. Now, if this were a business loss, you take 100%. But if this were a personal loss and your adjusted gross income was 60,000, you take out 10% first, and that loss was $8,000, your book value. So you'd have to take out 6,000. That leaves 2. Then you'd have to take out 100. So you get to take 1,900 personal casualty loss. So it's better to have a business casualty loss than a personal casualty loss. All right. Again, to see if you've been listening to the news. Trump says he's going to get more tax legislation passed before the election. Man, he's going to do this fast through the House and Senate, and they never do anything fast. For a 5-point bonus on your next test, what percent is he proposing? Just for the middle class, for a 5-point bonus on the next test, what percent is he proposing? Okay. What?
30.
Good guess, Co.
35.
10. Just on the middle class. And most of your families will be considered middle class, okay? Not on the poor, they don't pay taxes anyway. Some of you may not pay taxes. You're still in college, you're definitely poor. All right, most of you. But not on the upper class. Bill Gates has got enough tax breaks. All right. So do some of these other people. Steve Jobs, isn't he dead? Is he dead? Now, Cole knew that. All right. So that's a little overview of casualties. Now look at page 16, if you would. Look at your definition of a casualty. According to the IRS, a sudden event is one that is swift, not gradual or progressive. Now, a hurricane is pretty gradual. Earthquake is gradual. A fire can be gradual. And then there's the theft. But look at the list of events that the courts have held to constitute a deductible casualty loss. Now, the one I mentioned at first, didn't know it would come up here. Rust and water damage to furniture and carpets caused by the bursting of a water heater. And I told you the damage caused by a rusty pipe is a casualty. Damage to the exterior paint of a building caused by a severe, sudden, and unexpected concentration of chemical fumes in the air. Golly. I hope we never get those chemical fumes in the air that takes the paint off our house, right? I've got a sister that lives out in Nebraska. I went through Indiana one time and they have hog farms. So that odor was deadly. But the upper part of Texas, this summer when I was going through it, they had cattle pens. And they have them side by side, back to back, head to head, 20 and 30,000 cattle in one pen. Can you imagine what a stink 30,000 cattle's made? That smell lasted for a mile or two up the road on the interstate. So I got a sister in Nebraska, And she said, no matter how cold it gets, when they clean those cattle pens, they're miles away, but she says the stink is almost unbearable. Okay. And they get insects. I don't know what they cause. Loss caused by fire, unless the taxpayer sets the fire, in which case, no deduction. Now, if your house burns down, it's a casualty loss. If you burn it down, it's not. So if you burn it down, you better be deceptive enough to hide your arson's work. Okay. Damage to a building caused by an unusual large blast at a nearby quarry. All right. These things do happen around the country. Death of trees just a few days after a sudden infestation of pine. Okay, so pine needles comes in and kills 100 trees, 100 little Christmas trees. Okay, that's a casualty loss. Okay, but now look at this next list. These are not casualty. Water damage to the walls and ceiling of a taxpayer's home as a result of gradual deterioration of the roof. Trees dying because of suffocation of the root system. The loss of trees and shrubs because of disease. Damage to carpets and clothing caused by moths. Any of y'all ever get moths? Have you, John? I've had 3 or 4, but I forget how I got rid of them. I know I got little cedar shavings, and I put in all the closets and so forth. I think I finally got rid of them. Plus, I had, and I guess the bug man come and sprayed, might have killed them out. But now moths can eat up your clothes. Damage to a road due to freezing and thawing. Damage caused by drought because it occurs through progressive. The steady weakening of a building caused by the normal wind and weather, and the rust and deterioration of a water heater. These are not casualties. All right, a theft. Now, you may lose something this year and you don't know it. So, whenever you discover a theft happens, that's when it's deductible that year. All right, I have illustrated the deductible amount of a casualty loss. All right, look at example 23, page 20. All right, you had 2 casualties this year, I guess. Let's see. A storm declared a federal disaster area incurs a $4,000 casualty loss during the year. She also sustained $600 loss from a flood, another disaster area. Now, if the president comes in and declares a place a disaster area, that helps with taxes. Now, if he declared it right now, today, you can, yes, take it off on your 2018 taxes, or you could go back a year and redo your 2017 taxes and get a refund back from 2017. Okay? Now, I told you about a casualty, and I hope all of you heard it. Whether it's your parents or your own home, you should have a video for insurance purposes, tax purposes, whatever purposes, of everything in your house and every room, because it's hard to remember that stuff if you go to applying for insurance or casualty. Now, it's my son down in Cleveland, Tennessee. He had a water filter in his kitchen. It busted. And they got up the next morning and on the main floor, all right, then upstairs it was not hurt. Then they had the main floor, but they had the basement built in, just as a family room and storage and so on. They got up the next morning, there was water in the house. All right, it had dripped down to the basement that they had built in. There was water in the floor. Now, little things that you wouldn't think about, the insurance replaced it. Because they replaced the wood floor, first floor, the carpet in the basement. If it got into walls, they replaced some of the walls. It messed up that one cabinet, so they replaced all their cabinets. They couldn't match them. They put the old cabinets out in the garage, held them up for them and everything for storage. Okay? But if my grandsons had a pair of earphones laid in the floor, it got wet. Or one of them had an iPad in the floor, it got wet. One had, I guess, the earphone beads or whatever you call them. In the floor, they got wet. The insurance company replaced all of it. So that's what I'm saying. At the burn down, they would have remembered a lot of them little things. But the flood, they did, the water damage. We got a net casualty losses, and we'll practice that. All right. We will fill out the form. Now we'll talk about bad debts. Does anybody remember the one statement I said about bad debts last Thursday? What did I say about bad debts? All right. We've got the direct write-off method. You learn that in principles. It should also be an intermediate. And we had the allowance method. Allowance for doubtful accounts and allowance for uncollectible accounts. Which method I say IRS would take? The accrual basis of accounting, we use the allowance method. IRS likes the direct write-off method. Don't take it off until it's bad. How do you know it's bad? Somebody owes you $3,000. You read the paper, they're dead. It's definitely going to be a bad debt, isn't it? Somebody owes you $2,000. You read the paper, they went bankrupt. That's going to be a bad debt too, isn't it? Okay, so read about bad debts. Now, the toughest one in this chapter is page 28, NOL. Now, NOL is a business concept. As an individual, you don't have a net operating loss. Now, as an individual, see, Terry, you're married, aren't you? Got kids? Now, Terry, her expenses may be more than her income. How does she do that? She has charge accounts and credit cards and loans. She owes for a car or whatever. So, yeah, she may have a loss for the year, but that's personal. You have to have a business to have an NOL. And that's what we're going to look at. So please read NOL as much as possible. All right. And we'll look at those losses. Okay, that's going to be the chapter. We'll wrap it up. We'll start. Please start working some of the even problems and exercises in this chapter. So I'm going to cut off the video today. The only person out there watching this is probably Matthew Green. And Matthew, you need to get with me soon to give you some more time on your test. We're not going to go over those test answers today, but with this many people taking it, I will go over the answers Thursday and see how much we can add on to your test. So I'm going to stop broadcasting.